Equipment records. THE largest single investment that most builders make is for equipment. Your equipment is a fixed or long-term asset because you usually hold it for more than a year. You list your equipment on your balance sheet at its cost and depreciate it over its estimated life. The act of setting up an asset in the general ledger is called capitalizing. Capitalizing an expense sets up an asset which is taken or booked as an expense over a period of several years. In contrast, most other expenses are taken in the month payment is due or the month paid. Tax regulations don't let a business write off large equipment purchases in a single year. This is because the useful life of that equipment is longer than the year in which it's purchased. To take expense for a purchase over the life of the asset is to depreciate it. Generally, you minimize your taxes in the current year if you depreciate equipment as quickly as the tax regulations permit. But this isn't always the best policy, as this chapter will show. Fixed assets aren't actually fixed, so the term long-term asset is often used. This is more accurate because it describes an asset with a long useful life. It also distinguishes these assets from current assets such as cash and accounts receivable. This distinction is very important in the balance sheet because you can readily convert long-term assets to cash as you can current assets. Long-term assets that you buy with borrowed money are listed at their total purchase price, even if you still owe your bank the major portion of the asset value. You show the liability as a long-term debt. The part of that debt that's payable within 12 months is recorded separately and called a current liability. Current assets are expected to flow into cash within a year. Current liabilities include anything that is payable within 1 year. The entry to record a $15,000 purchase of a fixed asset with $12,000 financing would be, this entry shows the full amount of the purchase price as an asset, the true value to the builder. The note is divided into current and long-term portions. Any payments on the note reduce the long-term portion. The current portion stays the same each month. As each month passes, the current period is extended so that the current amount payable is always equal to 12 months of total payments. The well-organized builder should have a definite plan for fixed assets, a budget for acquisition of equipment, and a complete knowledge of the planned use. An established standard for return of investment in fixed assets. How many worker hours will a new piece of equipment save, and how much will it cost to own and operate it? A study of alternatives. Would it be better to lease or buy new equipment? Dependable and complete asset records. Records of maintenance costs and idle time. A policy establishing depreciation rates. An identification system for all fixed assets, either by labels, tags, or etched numbers. A goal for maximum use of fixed assets, including scheduling, minimizing idle time, and a maintenance policy. An estimate of the expected future market for the builder's services and the fixed assets required to meet that volume level. Have a clear picture of your own equipment needs and plan for them. Planning makes the purchase of a major piece of equipment a normal business process. Without a plan, the unexpected need for a replacement could delay your work. Investments tied up in unplanned major spending can affect your ability to meet payroll and other commitments. With a plan, you can compare your expectations about a fixed asset purchase to the actual results of having that asset. This should help you see whether the investment is a wise one. Equipment is a necessary part of your operation, but it should save employee time, make your operation more competitive, and speed up completion of your jobs. Most important, the investment should not impair your ability to meet your obligations. Classifying fixed assets. Your balance sheet should show enough detail to reveal the true position of your business. Lumping several asset categories into one total obscures your investment in any single part. The following balance sheet categories are typical of what most builders should use to classify their fixed assets. Office furniture and equipment includes all desks, chairs, file cabinets, tables, computer equipment, typewriters, adding machines, and fixtures. Trucks and autos includes delivery vehicles, automobiles, and any vehicle used in the general operation of the business. Machinery and equipment covers a wide range of assets, including construction equipment, tools, specialty machinery, and equipment kits. Small tools, many tools are included under machinery and equipment. Use this category for smaller, non-mechanical tools such as handsets and small appliance tools. As a general rule, these aren't capitalized because of their low cost and likelihood of frequent replacement. A building includes any structure owned by the company, excluding the land value. Improvements includes any renovation or addition to structures owned or leased. Land includes the value of any land owned by the company. This asset must be kept separate from all others since tax law excludes it from depreciation rules. All long-term assets are depreciated. The improvements classification is subject to amortization. This distinction is subtle. Depreciation is the recognition of the cost of an asset over a period of its useful life. Amortization is the process of spreading the cost. So, where depreciation uses up the value of an asset, amortization spreads the expense over a period of time. For example, you would amortize the cost of improving leased office space over the term of the lease. Fixed asset summary. September 30, 20. Amortization. Figure 13 reporting assets on a balance sheet. There are several ways to list assets on your balance sheet. The least desirable is to lump all depreciation together after finding a subtotal. No distinction is made as to which assets are depreciated and to what extent. Undesirable as this method is, it's commonly used. That's because many companies don't set up their books to keep track of the accumulated depreciation by each asset type. Since accumulated depreciation is a negative asset, the yearly expense to depreciation is accumulated in this account. It's easy to record depreciation by category. Rather than making a two-line journal entry, debiting the expense and crediting reserve, the entry should look like this. Figure 13%-1 shows the most compact and informative way to report assets on a balance sheet. Totals are given for the total accounts, fixed assets, accumulated depreciation, and the gross and net totals in each category. Controls on equipment purchases. You should establish a procedure for processing in new equipment. The procedure you follow should only take a few minutes, but it will provide all the information you need later. It's easy to forget to record these details when you buy new equipment and difficult to compile some of this information later when you really need it. The record you maintain for each fixed asset should include the following: identification, assigned company number, classification of the asset, a model, serial, and engine numbers, whether the asset is new or used, the seller, date of purchase, location, cost information in detail. Maintain this information in a file or equipment record book for analyzing fixed assets. It supports all general ledger entries for equipment. Figure 13%-2 illustrates Johnson Construction Company's equipment record. Keep these forms in a file indexed by classification of asset. This provides both an easy reference and valuable historical data. Figure 13%-3 schedule of equipment time. In addition to your record of equipment acquired, you should develop detailed records for equipment utilization, control of maintenance cost. Your equipment purchase plan must include a number of key considerations. Provide adequate insurance coverage. The equipment must be adequately productive to cover its cost. It must be budgeted and affordable. On key pieces of equipment, keep a utilization schedule that records time assigned to specific jobs. You should also have a secondary plan, since equipment can break down at any time. Figure 13%-3 is a schedule of equipment time. Prepare a schedule like this for each piece of high-value equipment, as far in advance as possible. A worksheet like this is essential to help you allocate and plan equipment use. You could prepare separate schedules for each job by piece of equipment. Unit cost for equipment. Establish an hourly cost for high-value equipment. This requires certain information about each piece of equipment, estimated average hours of use and idle time. Repair and maintenance time. Repair and maintenance cost. Cost of equipment less the estimated salvage value. Estimated life of equipment. Cost of storage, insurance, and taxes. Operating costs including gas, oil, and accessories. This information will help you put together more accurate estimates and analyze project costs. A large part of unit equipment costs is the cost of operation. 13%-4 is an equipment cost summary form. Make it a habit to keep a record like this of operating equipment. The form breaks down the hourly operational cost and distributes that cost by job. Using both the schedule of equipment time and the equipment cost summary, you'll have about all the costs and bookkeeping information you need to monitor your company's equipment assets. In Figure 13-4, under Distribution by Jobs, record the amount of idle and repair time and the useful active time. Non-productive hours are as much a part of the cost of owning equipment as the productive hours. Naturally, the more non-productive time you have, the higher the unit cost will be. Well-maintained and scheduled equipment gives maximum use. Use the total hours assigned on the equipment cost summary as a basis of distributing costs by job. Figure 13%-5 shows how. Total monthly hours are summarized so you can see the total for repair and idle time, both as numbers of hours and percentages. Then you assign these two categories to jobs on the basis of operational percentage. Maintain all costs of operation as a percentage of total operation cost. In this way, all operational phases of the business are given a fair share of the total cost of operations for equipment. Figure 13%-5 shows an analysis for a 4-week period. The period for analysis should always be the same length so that no allowance needs to be made for a greater number of. Month is actually 4 working weeks. Figure 13%-5 equipment cost assignment, hours in 1 month. While actual expenses occur on a calendar basis, they can be applied to jobs on a 4-week basis. One common method of allocating costs over uniform periods uses 8 4-week months and 4 5-week months. For example, the first quarter would have 13 weeks. The whole 365-day year would look like this. The equipment cost assignment worksheet provides an hourly summary by job and shows the relative efficiency of equipment use. It also lets you set a standard for equipment use. The idle and repair time figures indicate the degree of efficiency at which equipment is working. A depreciation. Depreciation is designed to let businesses recover the cost of buildings and equipment over the useful life of that property. Writing off part each year spreads the cost over a period of time. Up to 1981, that period was referred to as useful life. With passage of the Economic Recovery Tax Act of 1981, the idea of depreciation was replaced with recovery, and the entire system of depreciation was replaced with the accelerated cost recovery system. Then in 1986, the entire system was reformed again, with the current rules dictated by the modified accelerated cost recovery system. Assets placed into service after 1986 are subject to Maker's rules. How to claim depreciation. There are several ways to claim depreciation. Under Maker's rules, you may use a prescribed method or elect to use one of several straight-line alternatives. But assets you began depreciating under the old rules can continue under the old method until depreciation has been completed. Questions you must ask before you begin to depreciate an asset are: 1. Is the asset depreciable? You can't claim depreciation on land, inventory, or intangible property. 2. Are you entitled to a depreciation deduction? The tax law states that you're entitled to the deduction only if you suffer the economic loss as a result of decrease in value due to use. In most cases, the one who suffers the loss is the owner of the equipment. But under some circumstances, you'll be allowed depreciation on equipment you lease. 3. What is the basis for depreciation? In most cases, the basis is the same as your cost. 4. When was the property placed into service? You begin depreciation during the year you begin to actually use property, not necessarily in the year it is purchased or paid for. The Maker's system dictates the depreciation periods you're allowed to use for each specific class of asset. The depreciation periods, called recovery periods, specify the time over which you can claim depreciation for that class of asset. Before Maker's, the concept of useful life was a determining factor in the number of years depreciation would apply. The true useful life of an asset was a primary factor in deciding how long a life the asset had for purposes of depreciation. In many cases, property actually appreciates in value. So the concept of useful life and depreciation doesn't truly reflect book value. If you own your own building, for example, it's probably worth more today than when you bought it, even though you've depreciated the structure down to zero. You're allowed to use the prescribed MACRS method, which allows for a greater amount of depreciation in the earlier years and a decreasing amount later on. Or you may elect in most cases to use an alternative straight-line method of recovery. You claim the same amount of depreciation every year for a specified number of years. At the end of that period, the asset will be fully depreciated. In deciding which method to use, there are several factors you should consider. 1. What overall effect will your decision have? You must elect to use the prescribed or optional method for all assets placed into service for each class life within any 1 year. 2. How important is future depreciation to you? If you expect higher net profits in future years, you may come out better with straight-line depreciation. But if you need the expense this year, the prescribed method may be best. 3. Get the advice of your accountant. Use a trusted professional's advice in setting your policy for depreciation. 4. Obsolescence plays an important role in deciding how to depreciate assets. On the one hand, you want to consider the true useful life. On the other, the tax code restricts how aggressively you can write off your capital investment. It's usually best to design a depreciation policy that most closely reflects your use and replacement of equipment. If you use a lot of equipment that declines in value very quickly, accelerated depreciation is probably more accurate. If you replace equipment frequently because of increasing repair and maintenance costs, using the prescribed method of depreciation may be best for you. Once an asset has been fully depreciated, it's either removed from the books altogether or left in place. There are several ways for builders to handle adjustments for fully depreciated assets. Removing a fully depreciated asset from your books isn't good practice. Even though it has been fully expensed, it's still an asset of the company. Don't take it off the books until it's sold, traded, or abandoned. Once you do dispose of an asset, credit the value in the asset account and reverse the entry for your depreciation reserve. There are 2 ways to record depreciation. Both of these are acceptable ways to record the expense. In the first, you make an entry for the part of the year you first own an asset. For example, an asset purchased on July 1 would receive exactly 1/2 year's depreciation during the first year. The second method would be used by builders who buy and sell a number of assets during a year. A full year's depreciation is taken on assets purchased between January 1 and June 30. Assets purchased between July 1 and December 31 aren't subject to depreciation until the following year. The weakness of this method is that the recorded cost of doing business is distorted if purchases and sales of assets weren't spread fairly evenly over the year. Other depreciation records. If you have a substantial investment in fixed assets such as buildings, equipment, or machinery, you'd better maintain your asset records as well as you maintain your equipment. Complete records for repairs and maintenance, hourly usage, insurance cost, and depreciation are essential. Surprisingly, even established builders who've been in business for years have a difficult time breaking down their accumulated depreciation by units. As a result, fully depreciated assets no longer in use remain on the balance sheet. Equipment asset accounts you carry should be backed up by subsidiary records to substantiate the components of each balance. Few small to moderate-sized operations can support their general ledger accounts. Yet this is a relatively easy set of records to maintain. It makes the difference between a clean set of books and records that can't be explained at all. You can maintain good depreciation records in only a few minutes each month. Your record should include complete cost data from the purchase date of the equipment to the present. The depreciation record should balance with the total of the accumulated depreciation account in the general ledger and with the depreciation expense account for the current year to date. Figure 13%-6 is a depreciation record form used by Johnson Construction Company. The company keeps a sheet like this for each fixed asset it owns. These forms are filed in a binder by classification of asset, similar to the filing system introduced earlier for equipment records. Each asset should have a separate page for recording depreciation, But you can use a single page to cover small tools bought in bulk. You can attach a second page, itemizing the various pieces that make up the one asset being depreciated. For practical purposes, each single purchase should be considered one depreciable asset. A form like Figure 13-6 lets you compute depreciation far in advance. Simply check the booked column each month to find that month's figure for the depreciated value. Then, to control the journal entry, compute the total of all depreciation calculated for the current month by category of asset. This way you know that the current month's entry is correct. If depreciation has been computed reliably and fairly, this record also serves as a signal when the assumed useful life of an asset is coming to an end. Analyze repair and maintenance bills to discover if the cost of operation is getting high enough to justify buying a replacement. Depreciation methods. There are two ways to depreciate assets. Not all of these are appropriate for depreciating new equipment, although you may continue to use older methods on equipment that's held over from prior years. These methods include straight-line depreciation and declining balance depreciation. Straight-line depreciation. Straight-line depreciation is a way to spread the cost of an asset evenly over its useful life. The same amount of depreciation is taken each year until the depreciable base is reduced to zero. An asset worth $8,000 with an estimated useful life of 10 years and no salvage value would depreciate $800 per year. If the same asset had a salvage value of $1,000, the depreciable total of $7,000 would be depreciated at the rate of $700 per year. You figure the amount of straight-line depreciation by dividing the depreciable base by the useful life. In the example above, the total of $8,000 is divided by the useful life of 10 years. If the useful life was estimated to be 8 years, the formula would be, this can also be expressed as a percentage. A 10-year life can be expressed as 10% of the depreciable base. An 8-year life could be expressed as 12.5% of the depreciable base. Accelerated methods. Recognize the greatest loss of equipment value earlier in the useful life on the assumption that the decline in value will be less in the asset's later years. Use the straight line method for assets that you assume will be as productive near the end of their useful life as they are in the beginning. Also consider repair and maintenance costs and the cost of obsolescence. Equipment that will require progressively more maintenance as it ages should be put on an accelerated depreciation schedule. An example of straight-line depreciation is illustrated in Figure 13-7. Assuming a 10-year life each. Figure 13-6 depreciation record. Years depreciation is based on the original depreciable amount. At the end of that period, the depreciable amount less depreciation is 0. Any value remaining is the asset's salvage value. Declining balance depreciation. Declining balance depreciation is especially appropriate in the construction industry because most new heavy equipment loses most of its market value fairly quickly. Automotive and mechanical assets depreciate right after purchase, even though the true. Straight-line depreciation. Each year's depreciation is 10% of the depreciable base. Depreciation. Figure 13-7 example of straight-line depreciation. Value of that asset to the builder changes very little. You reflect much more closely the true market value of equipment and machinery when you use declining balance depreciation. Under this method, a large amount of the original value is claimed in the early years of an asset's estimated useful life. To calculate declining balance depreciation, the first step is to calculate the straight-line depreciation, ignoring any salvage value. The second step is to increase the straight-line depreciation by the declining balance percentage selected. There are several percentages used with declining balance depreciation: 125%, 150%, or 200%. Under the straight-line method, the depreciable base never changed. But under the declining balance method, the depreciable base is reduced each year by the depreciation taken up to that time. The adjusted value is used to compute the next year's depreciation. This method is illustrated in Figure 13-8. The 200% rate is the most common rate used in declining balance depreciation. Declining balance depreciation allows expensing amounts much higher than the straight-line rates during the early years. The depreciation taken during later years is considerably less. You load most expense into the early years of an asset's life. If you expect assets to be subject to higher maintenance costs in the later years of useful life, straight-line depreciation would result in steadily increasing cost. Depreciation would remain level throughout the term, but higher maintenance costs in the later years would raise costs significantly. As a result, the unit cost of the equipment would increase as the equipment became less valuable. The declining balance method, if applied through each year in the recovery period, will always leave some residual value. In the past, that would be the estimated salvage value. Under today's MACRS rules, the entire asset is depreciated. IRS declining balance tables revert to straight line for the final years in the recovery period. Which method is best? There are advantages and disadvantages to each method of depreciation. At best, depreciation is only as good as the estimate of useful life and the proper distribution of the cost. And that depends entirely on your guess. There's no way to know the exact value of fixed assets. You've got to use averages. But there are enough distinctions between the two principal methods that you should be careful to pick the right one for your particular application. The most appropriate method depends on the type of asset being depreciated. A comparative summary of the principal types of depreciation is shown in Figure 13-9. Assuming a 10-year life and a depreciable value of $60,000, the yearly depreciation is listed for straight line, 200%, 150%, and 125% declining balance methods. Assume that you sell the equipment depreciated in Figure 13-9. If the sales price is higher than the depreciated value you're currently carrying on your books, you have a gain that recaptures part of the depreciation. But be aware that depreciation in excess of the actual decline in value often creates tax problems when the asset is sold. Your accountant should be able to advise you on the best method for your situation. For complete financial reporting, it's always a good idea to list in detail both the total value of assets in each category and totals for depreciation in each category. Refer back to Figure 13-1. Any significant difference in the various depreciation methods being used should be footnoted. For example, footnotes for Figure 13-1 might be: office furniture is depreciated on a straight-line basis with a remaining life of 7 years. Machinery and equipment and small tools are depreciated on a 200% declining balance basis with a remaining life of 4 years. Office building is depreciated on a straight-line basis with a remaining life of 32 years. Improvements are being amortized over 5 years, assuming a depreciable value of $60,000 in a 10-year life. This kind of complete disclosure is rarely needed, but you should include enough in footnotes to indicate that a major portion of remaining depreciation for various assets will be realized in a specified period of time. Class lives under MACRS rules. The following class lives are specified under MACRS rules. 3-year class, for assets that previously had a useful life of 4 years or less. 5-year class, including computers, typewriters, photocopiers, automobiles, light trucks, and telephone switching equipment. 7-year class, office furniture and equipment, for example. 10-year class, assets with previously categorized lives between 16 and 19 years. 15-year class, assets with lives between 20 and 24 years. 20-year class, assets with lives of 25 years or more. Assets with live year class, for residential real property, including rental manufactured housing. In the 3, 5, 7, and 10-year classes, the MACRS prescribed method involves using double declining balance depreciation for the first part, then reverting to straight line for the balance of the period. The 15 and 20-year classes employ 150% declining balance, then revert to straight line. And the 27.5 and 31.5-year classes are allowed to use straight line depreciation only. Figure 13- shows you depreciate under what's called the prescribed method of depreciation. It means that the 200% accelerated depreciation rate is used in the early years, reverting to straight-line depreciation in the later years. Figure 13%-11 shows an alternative method of applying the 150% accelerated method, with reversion to straight-line depreciation in the later years. You can make an irrevocable election to use this method instead of the 200% method. This election has to be applied to all property within a specific class and for the year that assets were placed in service. Your decision to use the 150% method in place of the more common 200% method is a matter of tax planning. The right decision depends upon your need. Figure 13-10 Summary of depreciation percentages for a deduction in the current year versus the anticipated need in future years. Before you decide to switch, you should discuss the benefits of each method with your tax advisor. You can also elect to use straight-line depreciation for property. Straight-line is required for residential and non-residential real estate, but not for most other classes. You might determine that straight-line makes more sense because you believe the deduction will be more valuable in later years, for example, than in the first few years. The election is irrevocable, so make it only after you consult with your accountant. The decision to use the straight-line method is applied to all property within a class placed into service during the year. The number of years of straight-line depreciation varies. You'll need to consult your accountant for this election and for the applicable recovery period. You can make another important election to expense property placed into service in a year. That means you write off a lump sum instead of taking the deduction over a number of years. To qualify, you have to meet a few rules. The property has to be placed into service during the year in question. The election has to be made with the original tax return filed, or on an amended tax return filed by the original due date, including extensions. Once you make the expensing election, a reversal requires permission from the IRS. Figure 13-11 General and alternative depreciation system with 150% declining balance. You can't expense property held 50% or less for business, property held for investment, property you purchased to lease to others, property used outside the United States, property used for lodging, and some other restrictions that generally wouldn't apply directly in a construction business. The expensing provision is currently limited to a maximum of $19,000 in property per year. Partial year depreciation. Another rule you have to observe is that depreciation is adjusted according to the time of the year the property is placed into service. There are 3 methods available, and it's important to pick the right one for the class of property. The most straightforward of the 3 is called the half-year convention. This method assumes that all property is acquired halfway through the year. The amount claimed equals the first year depreciation reduced by 1/2. The second method available is called the mid-quarter convention. Under this method, depreciation is assigned as though the property was acquired halfway through the applicable quarter. If you're on a calendar tax year, all property acquired between January 1 and March 31 would be depreciated as though it were acquired around February 15. Depreciation for the first year would be reduced by the period preceding that. Here's a table of the rates that apply to the mid-quarter convention. Multiply the decimal values by the calculated depreciation for property acquired during each quarter. The final system is the mid-month convention. This is applied assuming property is acquired at the midpoint of a particular month. This system is mandatory for real estate depreciation and optional for most other classes. The applicable depreciation is multiplied by the decimal value as shown in the following table. If these distinctions seem minor, remember the system is designed to provide guidelines for a wide range of circumstances. Some depreciable assets are worth millions of dollars, so a mid-month convention could translate into thousands of dollars in deductions in the current year. The mid-month rules are more detailed for 3 classes of property requiring its use: 27-year, 31.5-year, and 39-year properties. To see these detailed tables and to check other rules about depreciation, get the IRS publication instructions for Form 4562. This and any other IRS form or publication can be ordered online. The website address is http://www.irs.ustrees.gov/prod/forms_pub/index.html.amortization. Note that In the footnote suggested for figure 13%-1, improvements to the building are being amortized over 5 years rather than depreciated. Amortization spreads the cost of major expenses over time. The cost of improvements is listed at its gross value in the same way as our depreciable assets. A reserve for amortization account is maintained just like the reserve for depreciation account. This is one type of amortization. Another type reduces the value of an asset. Instead of showing gross values, monthly expenses for amortization reduce the balance. This is used for accounts like organizational expenses. You can use different amortization treatments for different types of expenses. In the case of improvements, there is a lasting, tangible value. The improvements themselves. As long as those improvements exist, their total value should be shown. But there's no tangible asset for organizational expenses. This would include any expense not taken when incurred and which would normally have been expensed, except that the reason for the expense was related to the formation or reorganization of the operation. For example, suppose you have to spend the following to organize your operation. These are legitimate business deductions, but they don't apply exclusively to current operations. Instead of writing them off to expense as they occur, the correct treatment is to classify them as an asset and amortize them over a period of time. At the end of that period, there will be no identifiable, tangible asset, so the balance of the account should reduce to zero. For improvements, the gross asset is offset by a reserve for amortization account. But for organizational expenses, the asset is reduced each month. If this $4,340 asset were to be written off over a period of 3 years, the account would look like this: asset, organizational expenses. Because organizational expenses aren't fixed assets, they're included in the other assets category. Lease or buy? The question of whether to buy equipment can be a major decision for any builder. It's sometimes to your advantage to lease equipment. You get the following benefits if you lease. Equipment needed for single jobs can be leased for that job only. An immediate tax deduction is available for the cost of monthly leases. No large investment or financing commitment is required. You have the chance to evaluate equipment performance before buying. Leased equipment may be carried as an ASO statements if the offsetting liabilities are also included. This is the case only when the lease includes a provision for purchase at a future date. The agreement provides that all or part of the payments can be applied to the purchase. The amount of the lease payments is higher than normal lease payments would be. These points would normally be included in the terms of agreement on a lease option purchase plan. This type of plan lets a builder lease equipment without a large cash investment. This may be a good plan if you intend to buy in the future. If you change your mind and decide to get out of the agreement, you lose only the higher payments you've made and the equity you've been building up in the equipment. Under a lease purchase agreement, the full value of the equipment is included as an asset and the full liability, less equity, is listed as payable, both currently and in the long term. Depreciation on the equipment can begin immediately as well. The decision to lease or buy must depend on the equipment, its cost, the investment required, and the expected use. Will the use be regular or limited? What will the unit cost be? And can you justify owning the equipment on that basis? Can you afford the investment itself? Following is a comparison of the cost of leasing and buying equipment. Keep in mind that buying is cheaper for equipment that will receive regular use. All the costs of buying equipment are built into a monthly lease total. Except on a short term, leasing is not cheaper than owning. Sales and trade-ins. When equipment is sold, the books have to be cleared of all entries relating to that asset. This includes taking out the gross value of the asset and the accumulated depreciation on it. The other part of this entry is to book the gain or loss on the asset. These aren't operating gains or losses, and they have to be kept separate from regular sales and gross profits. Otherwise, your comparison of operating results will be distorted. Besides, gains or losses from sales of fixed assets receive different tax treatment from that of ordinary income. If a piece of $25,000 equipment, depreciated to $7,000, is sold for $4,000, the loss in the sale is $3,000. The general ledger entry for this transaction would be: a trade-in is recorded differently from a sale. For book and tax purposes, trade-ins aren't subjected to tax treatment until the replacement piece is sold or abandoned. The tax gain or loss is deferred by adjusting the basis of the new asset. In the previous example, assume that the $25,000 fixed asset was traded in for a $14,000 replacement. The general ledger entry in this case would be, this defers tax on the gain until the new equipment is sold.